All right, today we're tackling one of the most popular investment tools out there, the exchange-traded fund, the ETF. Ever wonder how you can own a piece of, the entire market without having to buy hundreds and hundreds of individual stocks? Well, you are definitely in the right place.
So let's just jump right in with a question. Imagine you wanted to invest in, say, the 500 biggest companies in the US. I mean, buying every single one of those stocks one by one, that would be a huge headache, right? Not to mention, super expensive. So, how do you do it? How can you pull that off with just a single click?
Well, the answer is actually a pretty brilliant solution. I like to think of it like a fruit basket, right? Instead of going out and buying an apple, then a banana, then an orange, you just buy the whole basket at once. Or, hey, look at these building blocks. You get a whole bunch of different pieces all in one box so you can build something way bigger. That, right there, is exactly how an ETF works. Okay, so the official name for this basket is an exchange-traded fund. It's this vehicle that pulls together a whole bunch of different investments. We're talking stocks, bonds, you name it, all into one single fund. But here's the magic trick, the really cool part. You can buy and sell it on a stock exchange just as easily as you trade a single share of, say, Apple or Google. So what is the big deal with ETFs? I mean, why are they so incredibly popular with everyone from total beginners to seasoned pros? Well, it pretty much boils down to 4 key benefits, and these advantages are what make them such a powerful tool for building wealth. So let's break these down. First up, you get instant diversification. With just one buy, you're spreading your money out, which lowers your risk. That's huge. Then they usually have really low costs, and we're going to dig into that in just a second. You also get amazing flexibility because you can trade them anytime the market's open. And finally, there's transparency. You always know exactly what you own.
Okay, but that low-cost thing? It's a huge deal for sure. But there's a little bit of fine print we need to look at. Low cost doesn't mean no cost. So let's pull back the curtain and see what you're actually paying for when you get into an ETF.
And you really want to get this right because even though ETFs are super cost-effective, there are a few different fees that can, nibble away at your returns if you're not paying attention. Understanding this stuff is absolutely key to making the smartest choices for your money.
All right, so the fee everyone talks about is the expense ratio. It's just a small annual fee the fund charges to manage everything. And as you can see here, it can be ridiculously low, like tiny fractions of a percent. But, and this is a big but, that's not the whole story. You really have to think about costs in 2 buckets. You've got your ongoing fees, right? That's the expense ratio we just talked about. But then you also have trading costs. These are the one-time costs you pay whenever you buy or sell. This includes things like commissions, although a lot of brokers have gotten rid of those, and something called the bid-ask spread. Yeah, let's zoom in on that one, the bid-ask spread. This is a sneaky little cost that a lot of people miss because it's baked right into the price. It's that tiny, tiny difference between what a buyer is willing to pay and what a seller is willing to accept. It might look like nothing, but trust me, if you're trading a lot, those little gaps can really add up.
And this table just lays it out perfectly. It shows you exactly why you have to look at the total cost. So, you look at ETFB and you think, oh, lower expense ratio, that's the one. But wait, look at that bid-ask spread. It's way bigger. And when you do the math, it turns out ETFA is actually the cheaper option. The takeaway here is so important. The lowest expense ratio isn't always the cheapest fund. You gotta look at the whole picture.
Okay, so now for the big showdown. Let's pit ETFs against their older, more traditional cousin, the mutual fund. Now they're similar, right? They both pull together money from lots of investors. But how they actually work is where things get really different.
This chart really spells it all out. The big differences come down to 4 things: trading, taxes, fees, and transparency. With ETFs, you can trade them all day long, just like a stock. They're usually more tax efficient, the fees are typically lower, and you can see exactly what's inside them every single day. Mutual funds, not so much. They only trade once, at the end of the day, and you get a peek inside way less often. What this all boils down to is freedom. It's about flexibility. Think about it. With an ETF, if some big news breaks at, say, 10 in the morning and you want to make a move, you can. You can buy or sell immediately at whatever the price is at that moment. With a mutual fund, you're stuck. You have to wait until the market closes and accept whatever that closing price is, no matter what's happened all day.
Okay, that's enough theory. Let's get practical. You got the what and the why of ETFs, but what about the how? How do you actually go from just knowing about this stuff to actually owning an ETF? Well, the good news is it's probably way easier than you think.
It's basically just a simple 3-step process. Step 1, you open a brokerage account online. Super easy,
tons of options out there. Step 2, you connect your bank account and move some money in. And step 3, the fun part. You do a little research and pick an ETF that actually matches your own financial goals.
Now I know what some of you might be thinking. You look at the price of some ETFs and one share might be hundreds, maybe even thousands of dollars, and you think, whoa, no way, that's not for me. But listen, the way we invest now has totally changed the game, all thanks to this one brilliant innovation.
And that solution is fractional shares. This is a game changer. It means you don't have to buy a whole entire share anymore. You can just invest with whatever money you have. You want to put $25 into an ETF that costs $500 a share? You can do that. Your broker just buys you a tiny little slice of it. It makes literally every investment accessible, no matter how much money you're starting with.
So there you go. That's the long and short of it. ETFs, they're like the ultimate financial Lego set. They give you all the building blocks you need: instant diversification, a cheap way to get into markets all over the globe, and the flexibility to build a portfolio that is perfectly, uniquely yours. So now you know the tools. The only question left is,